$12,000 still owed on a car that no longer runs. The check coming back? Roughly $3,000. That's a $9,000 hole, and it wasn't even his fault. No gap insurance. Parents pushing one way, his gut pushing the other. What he does in the next 48 hours could shape the next 5 years of his finances, and the obvious move here is actually the wrong one. Hey Profiteer, Eric here. Welcome back to Real Money Stories. Today's post comes from the personalfinance subreddit, and it's about a totaled car, a $9,000 gap between what's owed and what's coming back, and the pressure to decide fast while everyone around you has an opinion. The original poster is 26 works early morning shifts, and just found out the hard way what one skipped coverage ad on can cost. Let me read it to you in their own words. 2D6M, I was involved in an accident yesterday where the other driver was deemed at fault. It was a fairly low-impact collision and neither of us were injured. Unfortunately, I had $12,000 remaining on my auto loan, and I believe the payout will only be around $3,000. Like an idiot, I didn't get gap coverage initially and shopped around last year, but no one offered stand-alone coverage. I will be contacting the lender tomorrow to see what my repayment options are, as I was paying about $450 a month. I am very reluctant to rolling the negative equity into a new loan, but I need a car to commute to school, which is nearly an hour from me. My parents are urging me to roll it over into a new loan, but scared of making another poor decision. What should I do from here? Additional information, credit score mid-600s. Monthly income $1,200. Lives with parents, no rent. Commute to work is about 5 miles. Works early mornings, and public transportation isn't available. Okay? First thing I want to say reading this, none of this is on him. He didn't cause the accident. Low impact, nobody hurt, that's genuinely the best version of a bad day. And calling himself an idiot for skipping gap coverage. I dropped the label. He actually shopped for it last year and couldn't find a standalone policy. That's not carelessness, that's a gap in how gap insurance gets sold, pun fully intended. I've been writing about money for over a decade, and the thing almost nobody explains about gap insurance is that it's not really insurance in the traditional sense. It's a hedge against depreciation math. A car loses value faster than most loans pay down in the first 2 years. And if you total it in that window, you're on the hook for the difference between what you owe and what the car is actually worth. That's exactly what happened here. It's a math problem, not a character flaw. So here's what I'd probably do in his shoes, and I want to walk through this in order because the order actually matters. First framework, separate the two decisions. Call it decision splitting. Right now, these feel like one giant problem, the old debt and the new car, but they're two separate financial decisions colliding at the same moment. The $9,000 deficiency is debt. The need for a car to reach school and work is a transportation problem. And here's why that separation matters. The second you combine them, which is exactly what rolling the negative equity into a new auto loan does, you turn an unsecured, negotiable debt into a secured loan attached to a depreciating asset at a worse interest rate than he'd probably want for years longer than necessary. Keep them apart and each one gets a cleaner solution. Second, before he even talks with the lender about payment plans, I'd want him to push on the actual cash value the insurer offered. $3,000 for a car with $12,000 still owed sounds low, and sounds low is worth 5 minutes of checking. This is the actual cash value dispute, and it works like this. Insurers use a valuation tool that pulls comparable sales, and those tools miss things constantly. Recent maintenance, low mileage, aftermarket parts, even the exact trim level. He can pull 3 or 4 listings for the same year, make and model with similar mileage in his area, and send them to the adjuster as a documented request for reconsideration. This doesn't always move the number, but when it does, it moves it by hundreds, sometimes low thousands, and that shrinks the gap he's dealing with before he even starts negotiating the rest. Now, up to this point, everything's pretty textbook. Here's where it stops being textbook. Because even in the best case, disputing the valuation probably doesn't erase $9,000. It might knock it down to 6 or 7. And that's the moment his parents' advice becomes tempting because rolling it over feels like it makes the problem disappear. It doesn't. It just moves it, and it charges interest for the privilege. Which brings me to the third piece, call the lender and ask specifically about treating the remaining deficiency as an unsecured personal loan or an installment plan separate from any new vehicle financing. Some lenders will do this, especially for a relatively small balance like this one. And here's the why an unsecured personal loan can't repossess a car: because there's no collateral left to repossess. It's just debt he pays down on a schedule. With a $1,200 monthly income and no rent obligation living at home, even $150 to $200 a month against that balance is realistic, and that's the debt avalanche method in miniature. Throw the extra dollars at the single balance instead of spreading thin, and it's gone faster than people expect. Fourth, and separately, solve the transportation problem on its own terms, cheaply. He commutes 5 miles to work at odd hours, and school is nearly an hour's drive. That's real, that's not negotiable. But it doesn't require a $20,000 car, a reliable used car in the $4,000 to $7,000 range, paid for with a small, separate loan or even help from his parents as a private loan with real terms on paper, keeps the transportation fixed separate from the old debt. Mid-600s credit will get him a loan, just maybe not a great rate, another reason to keep the loan amount small. I'd also gently say this part out loud to his parents because they mean well. Rolling debt forward feels responsible in the moment, like the problem's finally handled. But the math doesn't care how it feels. It just compounds. One quick note, and I say this in every episode because it matters: I'm not your financial advisor, and this isn't personalized advice. Talk to a qualified financial advisor or even just a credit union loan officer about the specifics of his loan terms and credit options before any paperwork gets signed. So here's the so what? This post was about a $9,000 gap on a totaled car, but the actual lesson is bigger than cars. Whenever you're tempted to fold an old debt into a new obligation because it feels cleaner, stop and ask whether you're solving the problem or just relocating it and paying interest for the privilege. That question applies whether the number is $900 or $90,000. If you found this helpful, share it with someone dealing with the same thing. Until next time, stay profitable,